Hello everyone and welcome to another Mortgage Coach educational event. Today we're going to focus on sales and marketing compliance, and we have with us Mitch Kider as our special guest. My name is Dave Savage, and for the 16 years we've had Mortgage Coach, I've always believed strongly that trusted advice is the ultimate competitive advantage for a mortgage professional. It's not only great from a sales perspective, but it's important from a compliance perspective. So when you really break down the Mortgage Coach mission, we just have this firm belief that every borrower deserves to make a confident mortgage decision with Mortgage Coach education. So what we're in business of doing is helping mortgage professionals educate families with technology that powers confident decisions. To help me co-host today's call, I have our president, Joe Couture. So myself and Joe are going to interview Mitch and help you have a little more clarity on what it's like to be compliant. So, Joe, welcome to the call.
Hey, Dave, thanks for having me here, and thanks to the entire audience for being tuned into today's event. Turning compliance into a competitive advantage is critical in today's market. We have immense pressure to put the customer first, and as a lender, that really can be a very positive thing to both the bottom line and the pipeline. So when you look at today's event and the content that we're really going to share, it's all about helping the families that you serve make comfortable and confident home lending decisions. The mortgage can be an instrument for their personal wealth, and you can help be a very important part of that plan. With compliance as a focus, your organization will stand the test of time. So Mitch, thank you for being here again to share your wisdom with our organization.
Hey, it's my pleasure to be here with you guys.
Good. So we've got an interesting audience. You know, we asked Mitch Kider to join us for a lot of reasons, but whenever we're going through an audit, as we bring Mortgage Coach out to a large platform, Mitch's name comes up the most often. Whenever we go to a presentation, whether it's the MBA, Mitch Kider is always a speaker there. So we thought it was important to invite him to the Mortgage Coach community. So if you're on this call, you either got this email as a Mortgage Coach member or someone that we communicate with. And I want to do a big thank you to Rob Chrisman for putting a shout out and driving a bigger audience into this call. So Rob, thank you for helping share the vision. So Mitch, you know, we want to get right into it. A lot of people on this call, they know you. We do have CEOs on the call. We have heads of compliance on the call. You know, this was a great shout out that I received. You know, part of my process of preparing was that I sent out not a question, but I asked our leaders, what would you like me to ask Mitch Kider? We're going to have loan officers, branch managers, regionals, head of compliance, CEOs. What should we ask Mitch? So JERRA, actually, she gave me a few suggestions, but she also did a big shout out and appreciation for you, Mitch, because you made a big difference in her career. So I thought that was kind of fun, kind of interesting. Obviously, some of folks at the C-suite, they know you really well, Mitch, but some loan officers don't know you. So before we get into the questions, if you could just tell us a little bit about, you know, your role in the industry and the firm that you represent.
All right. So I am the managing partner of a firm that I started back in 1992 with two other people. It's called Wiener Brodsky Kider, and we are what is known as a boutique firm. We represent financial industries in the mortgage market. This is what we do. I represent independent mortgage bankers. I represent banks. All in both the primary and the secondary mortgage market. I litigate. I have defended more than 150 class action lawsuits in my career. I do a lot of compliance work. I try to keep people out of trouble and companies out of trouble, and basically act as a troubleshooter for mortgage lenders. The industry that we represent and the industry that I represent is a great industry. It houses America, and that's why we do this.
Beautiful. So this is the man that you call when you need him. And again, I know a lot of our clients have been proactive, doing mock audits and listening to you and your firm's advice to be more compliant. So if you're a loan officer on this call, you know, part of why, you know, Joe and I decided we needed to do a call like this for the industry is that loan officers need to make compliance their responsibility more than they're already doing it. It's not just the CEO's challenge. It's not the head of compliance. Mortgage professionals, you need to embrace compliance, and you need to make it part of your competitive edge. So hopefully you're paying attention and you're taking notes. So let's get right into the questions. You know, Mitch, let's start with this one. Like I said, I literally asked dozens of our clients and friends. I received north of 40 questions, and we weeded it down to 11. But this question came in from a lot of senior leaders and loan officers. You know, with so many originators out there engaging in disparatals, MSAs, you know, there's been a visibility shift from a regulator's perspective on this. So, you know, how does the CFPB see this, and what do loan officers need to do to be careful here?
So those are really good questions and really important questions. And let's break it down between MSAs and desk rentals. There's been a proliferation of marketing services agreements in this particular industry. And I get calls on a daily basis asking if I can enter into this type of a marketing arrangement or that type of a marketing arrangement, and always pointing out that it's very competitive out there, and many others are perfectly willing to enter into any type of marketing arrangement they can get with a realtor, with a builder, anyone else, so they can lock in that particular business. There really hasn't been any shift in the manner in which regulators look at marketing services agreements. And they look at those agreements with a lot of suspicion. It actually goes all the way back to 2010. In 2010, when HUD was responsible for RESPA enforcement, that agency issued an interpretive rule. That's a rule that doesn't go through notice and comment rulemaking. It's a rule that says this has always been the way it is, and we just want to remind you about it. And in that interpretive rule, it dealt with a situation of real estate agents selling home warranty policies and saying that what they were really doing was in fact marketing these home warranty companies. And there were all kinds of problems with that particular transaction. So HUD put in the interpretive rule that those transactions don't work. It was not really marketing. They were getting paid on a closed transaction basis every time they sold a policy, and all of those types of things are problematic. But HUD took the opportunity to go further and say, listen, when a builder or a settlement service provider like a real estate company, when they get into the marketing business, first of all, we wonder why they get into that particular business, because that is not really what they were created for. That is not why they incorporated, and that's not their main line of business itself. But they're in it, and now they're marketing. So what does that mean, and how do we, the regulator, distinguish that marketing from really just being paid for a referral itself? And in this interpretive rule, what HUD laid out was a policy that said, listen, you cannot have a real estate agent, a real estate broker, a builder, just marketing your services. So if you're a mortgage company, just marketing your mortgage company to their own customers. Because they're in a position of control, they're in a position where their clients look to them for advice on who to use and for advice and guidance and things along those particular lines. So what HUD said was, yeah, you can enter into a marketing services agreement, but it's got to be for real, distinct, necessary marketing services that goes to the general public itself. They went so far as to say if you're marketing out of a model home, for example, or if you're marketing out of an open house, then you're just marketing to specific customers, and that would be no more than a referral, which would be a violation of Section 8. But if you're marketing and it's reaching the general public, so for example, if a real estate brokerage company has a website and you as a lender want to put a banner ad on that website, that's marketing that's going to reach the general public, because people that are looking for homes, people that may not have a relationship with that particular broker, they're all going to be looking at that particular site as they look for homes in certain communities, and even as they look to hire a real estate agent or a real estate broker themselves. So if it's general, in fact, you go to the general public, an MSA will be okay. And that's the way the regulators continue to look at it now. Now the CFPB is in the midst of a couple of very large investigations of marketing services agreements and lenders and other settlement service providers that are involved in those particular agreements. And they look at it with a view toward whether or not marketing is in fact geared to the general public, or whether you're really just paying for a warm handoff or a referral itself, which would be a Section 8 violation. The other thing that is absolutely critical to know about marketing services agreements are that whatever services are being done you have to know what the correct value is to pay for those services. Because under Section 8 of RESPA, no one can pay for and no one can receive a thing of value for the referral of settlement service business. So if you're paying too much or you're getting paid too much for the marketing services that are being provided, the excess will be deemed to be a referral fee itself. So what you really need to do when you structure these marketing services agreements is go out to third-party experts, experts in marketing, in advertising, to get the services that are being provided valued so you know that you're paying, or if you're on the receiving end, you're receiving the right amount just for marketing itself. That's what marketing services are really about, and those types of arrangements are okay. And the CFPB has not come out and said those are not okay. HUD, prior to this, in fact, affirmatively stated in their interpretive rule that would be just fine. Just make sure it doesn't go to specific customers, it goes to the general population itself. Those are marketing services agreements. Now, desk rentals is another story as well, and that's also nothing new to regulators as well. In fact, if you go way back to 1996, HUD issued a policy statement in which they addressed desk rentals. And what they said about desk rentals was it's perfectly fine for one settlement service provider, such as a lender, to rent space in another settlement service provider's office, such as a real estate brokerage office. It's okay to do that, but the test as to whether or not it is legitimate is whether the lender, in this particular instance, is paying what HUD called the general market rent. Not the fair market rent, the general market rent. And so you ask, what is general market rent? And the test is the same amount of money that a non-settlement service provider would pay for that particular space. In other words, there's no value being attributed to the fact that you're sitting in a realtor's office so you can get referrals from that particular realtor. So maybe a barbershop wanted to open up in that space. How much would they pay for that? What does that translate to? That translates to really square footage. What is the square foot value of the space that you're taking up? That's really the only way you can do it. And by the way, the CFPB is active in this particular area because it wasn't too long ago, it was in January, that they entered into an agreement, consent order, following their enforcement investigation with a lender and their president, finding them both jointly and severally liable because they said that the lender had, in fact, paid too much for the desk rental. So they had to pay a civil money penalty of $54,000, and they had to disgorge any origination fees that they had collected for loans that they originated coming through that desk rental itself. So this is an area that is of high visibility. The CFPB is looking at it, and they've already taken at least one public action along those particular lines. So be careful. The other thing that you need to be aware of is if you're an independent mortgage banker and you set up a desk rental arrangement in a broker shop, many states, in fact most states, will say you better license your space over there as a branch if you're going to be taking applications out of that particular space. So that's just another thing to be careful about.
Perfect. So a couple things. One, I got a question in here from Ken Perry. Ken, I will try to get to this question, and for all you folks that are on the call, feel free to submit questions in the GoToMeeting question menu. So in the control panel where there's questions, submit those questions. I'm going to be checking it out when I'm not talking. But we got a lot of questions that have been submitted, so let's get to the next question. And again, keep submitting those questions.
So Mitch, from what you shared, clearly transparency is pretty important. I think that's part of the motivation of ensuring that when realtors and lenders are working together, that the homeowner has always benefited the most. So when you think about specifically quoting rates and displaying rate information, how does that align with the transparency and the goals of the CFPB today?
Well, transparency and consistency when you're quoting borrower rates is of the utmost importance. First of all, in terms of consistency, all of your potential borrowers have to be treated similarly. That doesn't mean that they all get the same rate quote, but you have to treat them the same way. You have to make your quotes do your quotes in a common fashion. So one is not treated differently than another. So in fact, your wealthier borrower doesn't get better treatment than your less fortunate borrower. And the CFPB looks at these things. There are a number of different laws that in fact are implicated by both the transparency and the consistency in borrower rate quoting. First of all, you've got fair lending issues. If you treat your consumers differently, you don't even have to worry about disparate impact at that point in time because you're talking about disparate treatments. You're treating them differently. And if in fact it shows that one minority group is being treated somewhat differently than another minority group, you're going to have a big problem on your hands. Consistency is absolutely essential over here. Now, in terms of UDAP, which is the unfair, deceptive, abusive acts and practices, and both the FTC and the CFPB have enforcement authority over UDAP itself, this is a law that's absolutely utilized in this particular arena, and it's very, very dangerous to cross the law. So what is UDAP? What is an unfair, deceptive, abusive act or practice? It's one that a consumer doesn't understand. It's one in which you might have hidden fees. It's one in which you use teaser rates and the consumer isn't aware of that. It's one in which you have borrower rates that are quoted, and then when the borrower comes back to the table, in fact, the rates are much higher. And it was never explained to them what factors come into play that put their rate together. So bait and switch is something that regulators look at, and it's a manner in which they look at rate quoting when in fact it changes. You have to be very, very careful along those lines. You've got to be careful about how you advertise your rates as well. And in fact, just this past August, on August 12th, a lender entered into a $20 million settlement based on deceptive advertising, where products resulted in higher interest rates and fees to the consumer, and they were higher than what was quoted or that was advertised itself. So transparency, consistency, getting it right is what's really important about that. And the third law that's implicated by all of this is FCRA, the Fair Credit Reporting Act. Remember, if you're going to risk-based price, you have specific notices and disclosures that need to be given along those particular lines. So I know, guys, that this is something that you're very interested in, and I know that you're working on a solution on this, which I think is excellent, because it's badly needed in the industry itself. And you can get into a lot of trouble if, in fact, you don't have the transparency and the consistency in the manner in which you're quoting rates to the consumer.
So Mitch, I think it's important when you talk about so many regulatory laws that impact at the point of transparency. A lot of the attendees here today are executive leaders, a lot of compliance leaders, branch managers, but also a lot of top producing originators are on the line with us today. So can you help kind of define where is the lender's responsibility and their obligations, the parent company, for providing the policies and procedures for transparency, and when is it the originator's real responsibility to ensure that they're being transparent?
All right. Well, it's absolutely the lender's obligation and responsibility to provide the policies and procedures. It stems from the lender's obligation to have a compliance management system. And a good compliance management system really has 4 different components, the first of which is policies and procedures. It's got policies and procedures, training, monitoring, corrective action. That is your formal written compliance program, and that goes into your compliance management system itself. Very, very important. So who provides the policies and procedures? The lender. But in terms of your loan officers, and for those of you that are loan officers that are listening, who implements it? Who makes sure that you're following the right policies and procedures? You do. You're responsible yourselves for ensuring that you know what the lender's policies and procedures are and ensuring that you follow those policies and procedures. Now, it may be that you turn around to your lender and you say, I need more training. It may be that you turn around and you say, I need to know what our policies and procedures are on these issues. A compliance management system starts up top. It starts with senior management. It starts with the board of directors. It starts with the lender, with the organization itself. But it has to move all the way through the company itself. And everyone in the company needs to know what their role is in compliance, how they play that particular role, what is required of them. That's what's critical. So lenders have to prepare you. They have to provide the policies and procedures, and you've got to implement them. And you've got to implement them correctly, because the CFPB doesn't just go after lenders. They go after individuals as well. They try to go after the people they think are responsible for whatever violation it is that they find. So this is critical stuff here.
So a couple thoughts. Again, we have both the C-suite, head of compliance, and we have loan officers. So I think it's important to understand loan officers. The world has changed. You know, the world where you quote the rate shopper one way and you deliver one level of service to someone who's grinding on you for fee shopping, and the way that you treat someone who's just happy to get approved for a loan, to treat those two folks differently, that's not the path forward. That's not what the CFPB wants. They want every borrower getting a great educational experience. Again, that's something that we're passionate about, is just every buyer deserves to make a confident, well-informed decision with transparency. So this practice that we have as an industry of treating people based off how they demand to be treated, or treating people at a minimum standards, it's not the path forward. I mean, I've been saying for years, my entire career as a sales leader, it's not even good salesmanship. The best salespeople, the most successful loan officers, they bring their A game to every conversation, and they're not happy until they've really delivered education and value. So what's been good salesmanship for decades is now really critical to compliance. Joe, do you have anything to add to that?
I think that when you look at consistency and control of the rate quote, everyone on this call knows that MortgageCoach has led the way for over a decade in helping to bring those presentations to life, and now on any device. But when you think about what Mitch just shared about the unified responsibility of making sure that those obligations are fulfilled, I'm hoping that we're able to help everyone be motivated to the simplicity that it can be to provide this type of information. I think that probably leads us to our next question.
Yeah, so Rich, real quick before we do hit the next question, just for everybody to be clear, a rate quote, there's the pre-GFE, so there's the GFE. When a rate is quoted, APR needs to be disclosed, and when that's put in writing, that is where the rate quote starts. Is that right? Could you define that a little bit for everybody, especially for loan officers?
That's absolutely right. I mean, if you're going to do a rate quote, you have to provide the APR. You can't just do a simple rate quote itself without the APR. You have to look at the trigger terms, and you need to follow the Truth in Lending Act in what it is that you're saying. Even pre-GFE, if you're going to be quoting rates, you need to be talking in terms of the APR.
Beautiful. So folks, just to connect the dots, you've got to have a policy. You've got to have a way that when that rate quote is quoted, that you can audit it, say this is our policy, this is how we're doing it, and all of those terms need to be met. Again, it's a gap that we have a lot of passion for solving. So again, part of my goal here, Mitch, is you speak to CEOs all the time. You speak to head of compliance all the time. It's probably not quite as often that you get to speak to originators, and I really just to help our industry and lead. Give loan officers just some perspective on why this is their problem. This is not just the C-suite's problem. This is a loan officer's problem. What's their liability here?
Well, the liability is pretty great. The bottom line over here is that the CFPB can and does impose personal liability. They do it on loan officers. They do it on executives. They do it on what they look for is the responsible party. They don't simply want to allow a company or a company that has insurance, the insurance company, pay off a fine, pay off a penalty, and have everyone move on along those lines. When someone violates the CFPB rule or CFPB guideline, and they want to impose civil money penalties, which can be great, quite frankly, which can be very high because they're tiered, and I'll explain that in a minute. But when they violate it, the CFPB wants to go directly to the individual, not just the company itself. So loan officers are specifically, for example, liable, have personal liability written into the statutory provisions and the regulatory provisions for loan officer compensation. And they can be liable for 3 times the amount of the direct and indirect compensation that they received, plus the cost of an action and anything else along those lines. For other rules, in each and every rule, there's liability written in by way of civil money penalties. Now, as I said, civil money penalties are tiered. If you violate a rule, if you make a mistake unknowingly, you can still be liable up to $5,000 a day at the CFPB's discretion, depending on what they think of that. If you should have known better, but you buried your head in the sand, it's up to $25,000 a day. And if you knew, believe it or not, the penalty can be up to $1 million a day. So these are game changers. These types of penalties, which are imposed by the CFPB, these are game changers. It means that a loan officer can no longer simply focus on sales. Obviously, sales is what you do. It's absolutely critical. Without a sale, without a closing, you haven't done your business. But it's not enough to stop there. You have to do it in a compliant way, and you have to do it in a way that shows that you have knowledge of what the rules and requirements and what your particular responsibilities and obligations are. That's absolutely critical. And if you're an MLO, don't think that, executives get away with that themselves either. Because if you look at a number of the settlements and enforcement actions that have been announced to date, you will see that many executives responsible for a particular practice have, in addition to their companies been fined, they have been fined themselves. And that's because there's a definition of a related person under Dodd-Frank. And a related person is a director, an officer, an employee with managerial responsibility for an entity that's a covered person. So your company is a covered person, and the person that's managing it, the person that's directing a certain project, they are in fact a related person. They have responsibility for it. So when you see something goes wrong, in almost all of the settlements that have come down to date and almost all of the enforcement actions that have been brought, in fact, it's brought against a company and several individuals as well.
So folks, it's not that complex. It's just doing it right. And again, most loan officers, they want to do it right. Just dotting the I's, crossing the T's, being a team player. It's that simple. So, the goal here in bringing Mitch to this call was not to scare the industry out of anybody. I mean, this business is fantastic. We're delivering the American dream. It's just, our industry is evolving. It's being regulated just like the financial planners have been for years, stockbrokers, and it's time for us to grow up as an industry and loan officers. It's time for us to dot the I's, cross the T's, and be great team players.
So here's the bottom line, Dave. You're absolutely right. It's really not that difficult at all. But the bottom line is you need to know what you're supposed to do, which really turns to your employer as well. You need to know what your company's policies and procedures are. You need to have direction on what you're supposed to do, and then you want to move forward and just do that consistently. That's the bottom line here.
Pretty simple. Let's just do it right, guys. So when you were reviewing lenders' marketing plans, policies, technology, what should loan officers, I think you somewhat answered it just now, but what should loan officers expect from their lenders and managers to provide them?
Well, number one, I did answer it to a certain extent, and that is they have to provide them with the rules, with the company rules, with the policies and procedures. They need to train them. They need to let them know what they can do and what they can't do. Very important along those particular lines. But when you're talking about marketing plans and policy and technology, let's look at a different angle, because I see a lot out there in which lenders are turning to their loan officers and saying, well, you pay for this, or you pay for that, or you pay for technology. And this is a dangerous area, and lenders need to be careful along these particular lines. Loan originators all through the country now are W-2 employees. They have to be W-2 employees. I mean, HUD insists that they be W-2 employees. States insist they be W-2 employees, and that's what you are. And as a W-2 employee, your company has to provide you with the operational tools for you to do your jobs. That doesn't mean that you can make demands on your company and say, no, I want this instead of that. But the basic operational tools, the company itself, it's their obligation to provide. Beyond the basic operational tools, you may want something else on your own that you purchase for yourself. That's a different story. But you have to be careful as a company, because FHA does not allow companies to charge their employees or make their employees pay for operating expenses. And many state employment laws, it's the very same thing. It's the company's obligation to pay the operating expenses itself. So, for example, an LO can't be asked to pay for equipment, furniture, office rent, overhead, employee compensation, advertising beyond, advertising that is advertising solely of the company itself, and similar type expenses. You may find yourself in a position where you want to brand yourself if your company allows you to do that as an LO, and that's a little different. There are some things that you can go out of pocket on and pay yourselves along those particular lines, but not the general marketing for the company itself. So it's the company's obligation to provide the marketing plans, the policies, and in general the technology to you. Compliance, as I said, really starts at the top. It's the company's responsibility to let you know what compliance is, what it means, and to ensure it happens. And then you've got to follow those rules.
So folks, we're getting just a ton of questions coming in. We may even have to ask you back, Mitch, because just mountains of awesome questions. I am going to try to get to these, but I do want to get through the prepared questions first. Joe, anything you want to add on that before we go to the next question?
Yeah, I think, Mitch, when you talk about what the lender should provide, and really when we reference technology in general, is it a fair statement to say that oftentimes when lenders are trying to share the expenses with employees, that there's a bit of penny-wise, pound-foolishness happening when the exposure is so great when technology isn't used properly?
Yeah, I mean, I think that's a fair statement there. It may be at times penny wise and pound foolish. The basic technology that's needed to run the business and have LOs do their jobs is in fact technology that is the responsibility of the lender. And it's the lender's responsibility to provide that type of technology itself. Beyond that, to the extent that there is something separate and apart that a loan officer determines they would just like, or is on a wish list or something else and not otherwise provided by the company, sometimes it does make sense to agree to share expenses, or sometimes it makes sense for the loan officer just to buy and pay those things themselves. But in terms of being penny wise and pound foolish, a company ultimately is responsible for what happens in its company, and it's responsible for overall compliance itself. And it has to know and understand the technology that's being used, and it has to stay in that process.
Well, certainly makes sense, and I think to the point for our audience here, we want to always be able to share our experience of over a decade and helping to ensure that those technology decisions that are made on behalf of the originator are simple to follow. Clearly, rate control and APR management all fall into that impact that you referenced earlier, and certainly should be overseen by the organization.
That's right.
Okay, folks. So this comes up all the time. I mean, there's never a time when we're doing a mortgage coach deployment. While most invest for that APR management to make sure that, hey, we have a policy. This is how rates are being quoted. We want to make sure that that's done compliantly. We want to make sure that loan officers are doing it, and that's being led from the top down. But it comes up all the time with just the whole open house flyer thing. So, Mitch, I guess, how would you answer this? Joint marketing with realtors, what are the rules as it pertains to loan officers writing checks to forge relationship with partners, and how does this apply to open house flyers?
Okay. Those are great questions, but let me start off by saying this. Loan originators, loan officers should not be writing checks to forge relationships with referral partners. I mean, first of all, a referral partner means they're going to literally be making a referral to you, and forging relationships by writing checks suggests that, in fact, you're paying for that particular referral. So they should never be writing checks, per se, to forge relationships. There is this concept of joint marketing, and under RESPA, joint marketing is perfectly fine. You can, for example, market together with a realtor. You can market together with a builder. What you need to do is pay your fair share of the marketing. You can't pay their share of the marketing. You have to pay only your fair share of the marketing. So number one, you need to have the value on the marketing. You need to have established that. And number two, you need to know how much of that marketing pertains to your business as opposed to your partner's business. How much of an ad are you taking up as opposed to how much your partner is taking up along those particular lines. Now, distributing promotional materials at an agent's office, I talked about that a little earlier, and at an open house, in the interpretive rule that was issued in 2010, there was language in there that suggested that that may, in fact, amount to no more than a referral. But I will tell you this, from a joint marketing perspective, if in fact you have the realtor's information and listings and you have yourself on the same advertisement or the same ad that's contained there or elsewhere, okay, just make sure that everyone is paying their pro rata share. That is absolutely essential. Now, I have clients that come back to me on a regular basis and say, well, it's just a de minimis amount. I don't want to ask the realtor partner for their share or something else along those lines. Well, there is no de minimis test here. And in fact, if a regulator is going to pick up one of those flyers and you're both going to be on that flyer, the first thing they're going to ask you is, how's this being paid for? And you better have the right answer at hand, because otherwise you got a RESPA problem. That's how you have to look at it.
So, this is always just such a rub, especially with open house flyers, because we're talking about pieces of paper. At MortgageCoach, we're really passionate about delivering advice in modern ways. And modern ways are just delivering it with a link that opens up on a device and just cutting the paper out. So we'll talk about that as we close the call. But there's a modern way to support a realtor at an open house. In fact, there's a lot of more modern ways to support people, and just you do it smart. We use less paper, less de minimis charges. So we'll talk about that. But loan officers, do this, guys, do this right. We work with a lot of lenders, from banks to independent lenders, and we see a lot of different ways that they address it. But every time we see it, it creates a lot of extra steps. So there's easier ways of doing it. Joe, anything you want to add to that before we move on to the next question?
Dave, I just think when it comes to joint marketing, it's so important for all of us to recognize the balance of what is healthy business and having good referrals from great customer service, and what it is to, as Mitch said, not write the checks. And of course, we shouldn't be, or nobody should be doing that. And so earning the referral, I think, is part of the focus of what you and I have been building as a culture. And I think that kind of brings us a little bit to our follow-up question around protected classes and disparate treatment. And so, Mitch, when you think about fair lending today, and you and I had a moment to talk a little bit about HUD leadership and whatnot, what is that key fair lending concern that, if you were going to break down the number one policy and focus that organizations should be aware of, because when you're doing it right, referrals will come. At least that's the way we looked at it.
So the most critical fair lending concern that a lender has, that a business entity has, evolves around its business practices, its business rules itself, the manner in which it conducts business. And it is really, the question really is, does my business rule, does the manner in which I'm conducting my business create a disparate impact? Is one group more adversely impacted by this rule, by this overlay, by my underwriting criteria or guidelines than another group itself? When it comes to loan officers, the question could be one of disparate impacts, but more importantly, it's one of disparate treatment. Am I treating everyone the same? Am I treating them fairly? Am I spending the same amount of time that's necessary to take their application, to talk them through it? Am I showing them all of the products that are otherwise relevant to their particular needs? Or am I treating different people differently, which in fact could result to a fair lending claim itself? So what companies need to have and what loan officers need to follow is, number one, a fair lending plan. And it's required, and the CFPB looks for it right up front. And it starts off with a policy. And that is that, in fact, you are a lender that believes in fair lending, and your policies are to follow ECOA and the Fair Housing Act, and to lend fairly and treat everyone equally along those lines. Number two, it is the review process. Policies and procedures for how your business practices are going to be reviewed to ensure that you know and understand who's impacted by these practices. And are there any particular groups more adversely impacted than others? And how do you do that? Well, there are many good fair lending companies out there today that sell software to companies. And every company should be doing fair lending reviews. There are third parties that will do it as well. It's more expensive along those lines, but today the technology has gotten to the point where one can run reports internally. And every company should be looking at their originations on a quarterly basis. They should pull out some matched pairs. They should pull out some CFRs, comparative files, and do analysis to see why pricing is different between one minority borrower and someone else that might not be a minority borrower when it appeared on its face that they were similarly situated. These are the policies and procedures that the CFPB requires. These are the things that try to keep you out of trouble. Now, the two key critical areas in fair lending today really are pricing and underwriting. And so companies have to have good, tight policies about discretion in pricing exemptions. Are you going to have exceptions? Can a loan officer, for example, price down? And if so, under what circumstances can they price down? And the reality is discretion should be very, very limited. The CFPB doesn't want loan officers to have any discretion whatsoever. Any. But that doesn't mean that you can't have some discretion, but you better have a really good, strong business justification for, in fact, making an exception, for pricing down, for example. So what is that? Competitive factors. But is it enough for you just to come up and say, well, I did it for competitive reasons? No. You have to have something. You have to be able to point to something that shows that, in fact, this borrower or someone else was making an offer to this borrower, or the rates that were being advertised at the time in this area, in this community, were, in fact, much more competitive. And in order to get that deal, you needed to match that particular deal. So pricing is really, really important. And the biggest problem we're finding in fair lending cases, and it's not just the CFPB, but the Justice Department brings these cases on a regular basis as well. The biggest problem that's out there really turns on discretion being given to loan officers, which in turn, on occasion, can be shown that minorities are the ones that end up paying the higher prices. I mean, the reality is, and I don't believe it's intentional, I've represented this industry for 33 years now, but the reality is, year in and year out, statistically it's been shown. when someone's being priced up and when someone's being priced down, okay, it's generally more minorities or a heavier concentration of minorities that are paying the higher rates. And the reality is, I've heard this over the years, loan officers, lenders, they say, well, you know, it wasn't discrimination. Some people know to come here and negotiate. Some people don't negotiate. First-time home buyers are less sophisticated and everything else along those lines. But I will tell you, the regulators and the Justice Department do not buy into those arguments at all. They do not. So you better have a more specific and precise business justification for pricing differentials if, in fact, you're in that position. Underwriting as well. You need to review overlays that you put on loans. You have to have very legitimate business reasons for the overlays itself, because your underwriting practices will be reviewed. They'll be run through a regression analysis to see whether or not a particular group is in fact more adversely impacted by that. And if they are, you in turn have to show that you had an absolute business necessity for that practice, for that particular overlay, and that there was nothing else you could have done less discriminatory that would have given you that same result. These are critical areas. Fair lending is the #1 priority of this administration, and it will be the #1 priority of all of the administrations to come, because fair lending is a matter of civil rights. So think about what you're doing there, think about how you're pricing, and think about how you're treating everyone, because you really need to treat them in a fair and equal manner. And in terms of companies, the policies that they need are policies that have to flush this out. You need these appropriate policies and procedures, and obviously training is absolutely essential, and so is oversight. You need to check to ensure that you don't have that disparate impact.
So Mitch, many of the executive leaders who are on this call, when they're formulating these policies and trying to fit in that stencil of ensuring that all of the variables are covered, one thing that we often hear in common is geography being a separator, whether it's for compensation or structure or just the way that they're presenting information to borrowers. How solid of a defensible position is geography versus the type of socioeconomic situations that you reference?
Well, let me put it this way. It is never an absolute defense to a fair lending action or a claim of discrimination itself. It may well be that different marketplaces, different MSAs, New York and California, or rural Kansas and Beverly Hills, will have different competitive markets, different overheads, different costs and expenses, and therefore different pricing. And generally, that different pricing is going to hold up, because you'll be able to document it and look to the marketplace and show the competitive pressures that are out there. But at the end of the day, when you talk about fair lending is global at your company. They're going to look at all of your lending to see whether there's any disparate impact itself. Then they're going to break it down by region, then they're going to break it down by branches, and then they're going to break it down by individual loan officers. That's how a fair lending analysis is properly done, and that's how regulators conduct their fair lending analysis. So you may well have a decent defense based on geography if you can really show those competitive pressures, those additional expenses, and items along those lines. But geography in and of itself is not sufficient. You can't simply say, well, I priced more over here in New York than I did in Massachusetts, without the business reason for why the pricing was in fact different. You always, because they're always going to look to see who's paying more, how are the borrowers impacted by that, and which groups are impacted by it. So it's a defense sometimes, but it's not an absolute defense. In the end, you always have to take a look and see what the fair lending consequences are of your pricing policies.
Sure. And when you have multiple branches in the same zip code, then that becomes more difficult as well, right, Mitch? If two branches ended up pricing different, the geography defense becomes difficult.
Yeah, there is no geography defense, quite frankly, if two branches in the same zip code are pricing differently, unless one branch in that zip code, is also licensed to originate loans, someplace outside of the MSA, far away, and they price differently just in that different area. Then you do the analysis I otherwise just went through. But the truth is, to be prudent, to be safe, and this is what I tell my clients. You should, at a minimum, be pricing the same within an MSA, within a metropolitan statistical area. You're not going to be able to justify different pricing based on the fair lending implications that you're going to recognize. It's been shown over and over again in this industry that, in fact, when you price differently within an MSA, statistically, it's protected minority groups that end up being the ones that are paying higher. And that's a problem.
So, Mitch, when you examine the reasons for loan officers, having issues, breaching compliance, what is it that you find most often?
Well, listen, a loan officer's job is to sell. They're to go out there and originate loans for their particular company. And for many, many years, loan officers, for the most part, were not so much worried about what the compliance is. They simply relied upon lenders in terms of rules, regulations, and how they would otherwise conduct their business. The biggest reason I see breach of loan officer compliance is a lack of training, a lack of knowledge along those particular lines. Today, you can't just be a salesman. You can't just be a salesperson. You almost have to be a lawyer too, quite frankly. You need to know and understand the rules that govern your business. And the only way you're going to know and understand it is by taking courses, by reading, by having your company provide you with what their policies and procedures are, and by getting trained adequately along those lines. That's the problem. Historically, that wasn't done very well in this particular industry. Even today, I mean, next week, I'm going to speak at the Mortgage Bankers Association's Regulatory Compliance Conference. So who comes to the Regulatory Compliance Conference? Compliance people, absolutely. Lawyers, absolutely. Some C-suite people come. But the loan officers come to these things? No, they don't. Yet loan officers really need to learn and understand what these laws are and what they need to do to comply. And so it's evolving in this industry. It's getting there, but it's getting there slowly. And that's the biggest problem.
Got it. So is the CFPB focused on national air advertising? The licensing disclosures for national air advertising can take up to 30 seconds, with really, from what I understand, not a lot of consistent guidance from the states. Should corporate MLS number be adequate?
Well, for the most part, what you're talking about here is not a CFPB issue. It's really a state issue. States govern their licensees and what requirements they have for on-air advertisements themselves. And most states, it is adequate to just put the NMLS number itself. But not in all states. Some states have very state-specific requirements. For example, Colorado, they require the advertisement include the name and the MLS number of the responsible party, the mortgage company's name, the business phone number, and a statement that says regulated by the Division of Real Estate. Other states have similar requirements themselves as well. It's not really the CFPB focus. It's something that they have left to the states. It remains there. And the answer to your question, unfortunately, lies in the rules of all 50 states. And
Got
to be
it.
compliant, someone needs to know the rules in all 50 states.
Got it. So everybody to set the table. I'm going to let this call push an extra 5 minutes because we've got just a couple more questions, but I want to make sure that we leave time for it, so the call is going to go about 5 minutes over. But as we start wrapping it up, I think we have another question here.
Yeah, Mitch, I think this question probably, in a lot of ways, you've answered it. But when you really talk about steering, and I think the point from the executive that shared this was concerns around steering in general. When you have originators who might just be giving one product or a fee worksheet, where does the best practice come into ensuring that originators are never looked at as steering people into a specific product?
Sure. Well, let's start with this. I mean, the LO compensation rule is an anti-steering rule. That's what it's all about. And when we talk about steering, what we're really talking about is putting your customer into a product that may not necessarily be the best product for them, but you're putting them there because you get paid more, because you can make more money off of that particular product. That becomes problematic. Now, for closed-end loans, the LO compensation rule has tried to, in fact, close that off, because you need to get paid pretty much the same or on the same rate of pay for every loan that you originate that's a closed-end loan. Now, there are some exceptions there, but that's pretty much the basis of the rule itself. But open-ended loans are not subject to the LO compensation rule. So you can get paid on a HELOC any way a lender wants to pay you, or you've negotiated that out. But that also creates steering problems, because your company may offer a closed-end second that may be better for the consumer, but you as a loan officer want to put them in that HELOC because you may be sharing in the profitability of that loan. You may be getting paid more along those lines. You've got to watch out for those particular problems. And so the answer as to what you can do during the loan process is, number one, you need to disclose the different products that are available for your consumer. Now, not everything is available for them, obviously. It's going to be based on a number of factors, including their credit factors themselves. But just disclosing one type of a loan is not going to do it for you. You need to explain to them what is otherwise available, and you need to document it. All of the new rules that came into effect in January of 2014, the LO compensation rule, the ability to repay QM rule, they're all really documentation rules. You're going to have and maintain documentation that shows what you did and why the consumer chose what it is that the consumer chose. That's what your real best practice is. That's something that historically has been missing as well, but something that you need to take care of today.
Well, we appreciate that, Mitch, and I think, Dave, you would echo the fact that that's been our mission for the last 10-plus years, is ensuring that consumers are aware of those options, and today more than ever, originators have to own the fact that they have to explain them in a way that makes sense to the consumer. So thanks for that clarification, Mitch.
So Mitch, what should loan officers expect in the months and the years ahead? I mean, we've had a big pivot and shift in increase in compliance. Is the big pivot behind us, and it's going to be a bit flat line? It's going to loosen up? Is it going to tighten?
No, there's no big pivot behind us by any means. Coming up to January of 2014, we knew we had 7 major rules that were coming out, and so the big push was to get ready for those 7 rules. But we're here now, so what's going to happen with those particular rules? Enforcement, and stepped up enforcement actions, and we're already starting to see that. For the first couple of months, the CFPB wasn't really auditing or examining for compliance with the new rules, because they wanted the industry to, in fact, get used to those rules and to learn how to comply with it. Well, they're auditing for it now, and they're doing target investigations for it now as well. So you see a lot of stepped-up enforcement, and you're going to see a lot more of it as the years come on. There are also new rules that are constantly going to come through. I mean, Dodd-Frank required a number of rules that we still haven't seen. So we have a new proposed rule for HMDA. And when that rule gets finalized, you're going to see a lot of new categories that are going to have to be reported on the law itself. And compliance is going to be absolutely mandatory, and the penalties are going to be very stiff along those lines. We have the new integrated mortgage disclosure that's going to take the place of the GFE and the 101 settlement statements, and going to combine in both on the front end and the back end the initial till and then the final till itself. And beyond that, we've got a couple more years of new rules that are headed our way, along with tight enforcement. There's no let-up in sight for this industry as it comes to compliance. I'm sorry to be the bearer of bad news, but that is the reality.
Well, the good news is doing things right, you know, truly caring about your clients, giving great advice, doing it in a consistent and fair way. I mean, it's good for selling. So for the companies that are our customers, you know, Ken Perry is a great compliance leader, and the concept of making sure that you have policies, making sure that they're reviewed, you know, no better leader than Ken Perry in the Knowledge Coop, and Ken's a big fan of what we do, talking about how MortgageCoach helps deliver a consistent experience. By the way, for folks that don't know it, Ken's got a big compliance event coming up. Make sure you check that out for creating policies. So, you know, what I want to make sure MortgageCoach leaders, you know, are really clear on is that, you know, whether you're delivering advice to a high-income rate shopper or a low-income, I'm just happy to get approved borrower, everybody needs to get the same experience. I mean, if you're on this call, you are either a mortgage coach or you're a friend of MortgageCoach. And I'm always delivering, we know what to do, let's just make sure we do it with everybody. So this is a really important touch point. Every borrower gets it, and it's important that we deliver it. But how we are winning that loan, how we are quoting rates, you know, first of all, a lot of loan officers are doing that with emails. They're doing that with we shout out rate quotes. And it's important that we leverage modern technology. So part of MortgageCoach's vision is to bring the way you deliver that rate quote into an iPhone, into a desktop experience. So wherever the borrower gets it, they're getting this simple advice, and they're getting it in a way that's compliant, in a way that a lender can say, this is our policy, and this is how we review that policy. So Mitch, we put this idea to do this compliance event together at the Optimal Blue Conference in Colorado a few months ago. First of all, there's been, I mean, I don't even know how many questions, Mitch, but there's been a lot of questions come through. Any chance we're going to be able to get you back in a call and make sure we get all the questions answered?
Yeah, let's do it again. I'll be happy to join you guys again. I'm always interested in loan officers and companies getting it right, because this is an industry that's really important. And so, yeah, absolutely. I actually am going to have to sign off now as well, because I am 5 minutes late for a call on a CFPB fair lending examination that's ongoing. So let's set up another time, and we'll get everyone back on, hopefully.
All right. Well, we'll definitely do that. I'm going to walk through just a couple minutes because I want to show some respect to our OB partners. Mortgage leaders, it's important from a technology perspective that you're implementing technology. And so I want to drive a quick video that just shows how to go from price to advice. It's just a minute long, and then we'll wrap up today's call. So, you know, it's important that when you price a loan, you know, you provide options. And, you know, one of the benefits of the Optimal Blue integration is that now you could go from, here's the price, here's the options, and now instead of just emailing the rate quote and the disclosures, you can just press a MortgageCoach button and boom, you know, now you have a link that you can put into an email, you can put it in a text, and it can be tracked. So, you know, we want to thank Optimal Blue for helping make loan officers go from price to advice, simple, quick, and just make that experience more valuable. So we did go about 5 minutes over. I'm going to wrap up today's call. Joe, are there any parting words or thoughts that you want to add before we wrap it up?
Well, thanks to the compliance community for attending, and Mitch, Thank you so much for sharing your knowledge, and we look forward to more in the future. To all those who are on the line today who have not become familiar with Mortgage Coach, we have a team of experts that are willing to continue this conversation and share the best policies and practices that we've helped many top-tier lenders implement. So feel free to reach out to Mortgage Coach by sending an email to success@mortgagecoach.com, and we will certainly keep everyone informed for Mitch's follow-up event to today. So Dave, with that, I appreciate having all of us on the phone today.
All right. Take care, everybody. Sorry we didn't get to all the questions, but we'll get them next time. Thanks again, Mitch.
All right, thank you. Bye-bye.